If you're joining me as a continuation from 4B into section 4C, you'll remember that we talked about having a payment plan versus dropping about $41,000 to save up to $100,000 for a college fund. In this section, and if you haven't read your section first, press pause, take a break, and go read it, and then join us so that it'll make more sense. Our savings plan formula is A, which you'll remember from 4B, is amount final. And in this case, equals PMT, not just P. PMT standing for payment and not principal, times the quantity on the top, 1 plus APR, still standing for the percentage rate, over N. This N, however, is different. It's not the number of compounds, but the number of payments made in a year, raised to the N times Y, N still being the number of payments made in a year, times Y, which is the number of years, minus 1 over APR over N. Let's go ahead and use this on our first example. Find the balance after 6 months of making monthly payments of $100 into an account with a 12% APR. So what we're going to do, and I'm going to show you how to write this equation for your own benefit. We're going to go into Insert and Equation, and we want to type in Shift A for capital A equals payment, PMT, and then I'm going to come up here and find my fraction, and I want this kind of fraction. Then I'm going to go up to the top and give myself some brackets, and I'm going to use my straight brackets, and then inside again I'm going to do parentheses, and that will be in here 1 plus another set of fractions. Put that in there. Press my over button and type in APR over down button N. Now I need to come out, and in here I need to raise that, but I need to tell my computer what needs to be raised, so I highlight all of that inside the parentheses, and there's my exponent. Now pressing my arrow button over, I type in N and Y, press my arrow button to get out of my exponent and do minus 1, and we have the top done. Now I'm going to click in the bottom, give myself another fraction, and press my over arrow button, give myself APR, down arrow button, or over arrow, divided by N. Now that you have it put in there, you can copy and paste this for the next time you need to make or use this formula, and then just go in and replace what you need. So in this case, my payment was $100. The APR is 12%, so change that to a decimal of 0.12. Delete my N. We are going to be making monthly payments, so that is 12 raised to the 12 times Y, 6 months. 6 months isn't a whole year, that's a half year, so I'm going to put 0.5. And we already know APR and N. APR is 0.112, N is 12 months. All right, now I can either type that all into my calculator or, showing you the fast way, copy and paste, bring it into an Excel spreadsheet, Control V, and remember, if you want it to work like a calculator, you need to preface it with an equal sign. Now, it doesn't recognize a space or a blank as being a time sign, so you must tell the computer that. Also, it doesn't do the square brackets, it only does sets of parentheses, so make sure you get that set fixed, and I think everything else is good to go. Press enter, and I'm going to go ahead and format this as currency. We have $615.20, which matches what I previously put down. I'm going to go ahead and erase that so my notes still match up. And notice we're going to highlight this in some fashion to make it read as the answer. All right, retirement plan. Let's say at age 30, you have an IRA savings with $100 deposited at the end of every month with a 6% APR. You retire at age 65, which gives you 35 years later from age 30 to 65. How much will you have saved at the end? Okay, so we're going to use our payment or our savings plan formula. You can copy and paste. In fact, let's go ahead and do that. I'm going to copy this, bring it down, just so you can see how we do that. Control V, bring it over. Okay, payment. We are making $100 deposits. Pressing over with my over button or my arrow button, delete this out, and we have an APR of 6%, which is 0.06 as a decimal. N is the number of times you pay in a year, so this is every month, which makes that 12. Over arrow, N again is 12, and we're going to put a time sign so I don't think that it's 1,235. So put a time sign. There we go. APR. Delete that out. My APR is 6% and number of times paid is 12. Copy and paste this into Microsoft Excel. Copy equals Control V, and remember we must put a time sign. I know some of you are thinking, who have followed me from the very beginning, that I'm repeating myself frequently. I'm going to assume that not everyone is following along and may jump in and out. Okay, so we changed out the brackets for parentheses, got the time sign in there. There we go, 142,471. I'm going to go ahead and press copy. Go back into here, equals, Control V, copy it in. There's the answer. That'll help speed you up on your homework supplements. All right, so, and notice I've also made this a different color, even bolded it, some way to identify it as the answer. All right, now with this retirement plan, how much money did this person actually deposit of her own money? So let's go back. If this person is depositing $100 at the end of every month so $100 every month for 35 years, it's just a matter of multiplying. $100 times 12 months in a year times 35 years. You can even think of it as a unit conversion, which we did in Chapter 2. So in fact, let's go ahead and go through that because I know I have something down there, but that's the answer. I'm going to show you how we would do a unit conversion. Let's go ahead and do $100 per month. So I'm going to, because I didn't give it a fraction first, I'm going to highlight this and make it a fraction, $100 per month or every month. Now I want to know how much at the end of 35 years. So I'm going to times this by Shift 8, times that by my next fraction, which is 12 months in a year, 1 year. Now that I have a month on the top and the bottom, I'm going to go up here and cancel it out, one on top, one on bottom. There we go. But now I've only done 1 year, so I need to multiply that by my next one, which will be, actually, I don't even think I need a fraction, so we're going to do 35 years. I could have done a fraction and put it over a 1, but that's okay. And the years will cancel because I have one on the top, one on the bottom, and that's how we would have done it with unit conversions. Either way, we still end up with 100 times 12 times 35, which we talked about from the beginning, and highlight your answer. I'm going to go ahead and delete that so that my notes still line up with the pages, and I have $42,000. She only deposited of her own money $100, 12 months for 35 years, $42,000, and she ended up earning or growing that to $142,000. So she earns over $100,000 in interest, and we can find that just by subtracting $100,471.03. All right, let's kind of go backwards now. Let's plan ahead. How much money do we need to start with or to start for each payment for each month. So my payment formula is now solved for the payment. So I take our original, and of course right here is a multiplication sign. You don't have to have it in there. With Excel you do, but we know that if nothing's there it means multiply. So the opposite of multiplication is timesing, or is dividing. But I'm dividing by a fraction. And we don't divide fractions, we multiply by the reciprocal. So I'm going to flip this whole fraction upside down, and I end up with n over APR down here. So I have payment equals, and of course the A was on the other side still. So multiply, or flip and multiply, and we end up with our payment formula. Okay, remember in section 4B how we had the college savings plan, and let me refresh your memory. Here's our college savings plan. We needed $100,000 in 18 years, and it was compounded in this case once a year at 5%, and we did a better option of finding 7% compounded monthly. Either way, you needed either a chunk of change of $41,552, or in the better option, you only needed $28,469.43. Either way, it's a big chunk of change. So a more feasible option is making payments. So we're going to use our same example that we used in the other one and have a 7% APR, and we want to save our $100,000 in 18 years. But in this case, we're going to make monthly deposits instead of just assuming that you have $28,000 in your back pocket, you know, chump change. So we can take this, and I've already shown you in this section how to type in different things in Microsoft or in Word by using your equation tools up here. So I'm going to assume that you're okay with that, and I'm just going to highlight this, copy and paste it down into here, and then fill in with the information I have. I know that the amount final is $100,000. My APR is 7%, 0.07, over 12 because I'm making monthly deposits, and then 1 plus APR is 0.07, N is 12, again 12, and so this doesn't look like 1,218. I am going to put the time sign in there because we have 18 years, and subtract 1. There we go. Now I know some of you will go ahead and use that in your calculator, but we're going to show you again how to just copy, paste, and fix up a couple of things. Make sure you have a time sign, and a time sign, good, but Microsoft does not like these brackets, Excel, so I'm going to delete the brackets and put in parentheses. It looks like everything's good to go. Press enter. There we go, $232.17, which is right there. And highlight it in some way so I know that's the answer. All right, how much was deposited in this example? So if we have $232.17 a month, making monthly payments for 18 years, we do 232 times 12 months a year times 18 years, which gives us $50,148.72. Let's compare it to what was deposited in the example from 4B. In 4B, if you wanted to make one large sum payment and build at 7% compounded monthly, you'll end up needing $28,469.43. This one, about double that, but it was nicer because you only had $200 a month payments. All right, let's move to the next example. Our retirement example is in 25 years from now, and by the way, I would take careful note of this example. In 25 years from now, Janice wants to retire and live on an income of $50,000 a year forever. She has found an account that has a 9% APR. What should her monthly payments be to accomplish this goal? The first thing we need to do is figure out what kind of interest or balance this 9% interest can give for the $50,000 a year. So it's 9% times some sort of balance that'll give her this $50,000. So I divide both sides by 0.09, which is changed to a decimal. $50,000 divided by 0.09 gives me $555,555, or if you round up, you can make that a 6. For this account, that the 9% every year will give her $50,000. So we need to, she needs to earn about a little over $500,000 to live forever on a $50,000 income. Now that's kind of cool because she can continue passing this down to her children and so on. So we take our payment formula, which was really the savings plan formula solved for payment, and we put in A, $555,556 because we rounded up from the 0.5 times APR is 0.09 over N, which is 12. Divide that by 1 plus APR is 0.09, N is 12, to the 12 times 25 because it is in 25 years from now, minus 1. You can use your calculator or Microsoft Excel. I'm assuming by now that you've seen me do Excel enough. Copy and paste, and we get $495.93. So if she saves almost $500 for 25 years every month, she should earn up to a little over $1 million or $500,000 and just live on the income or the interest that comes off, which should be $50,000. Take note of this problem. That's a hint. Roman numeral 3, total and annual return. The total return for something is the amount final minus the principal over principal. Now if you'll remember, back a couple of sections we did new minus old over old. That's the exact same thing, except it's in financial terms. So if you don't want to memorize this one, you already have the other one memorized. New minus old over old. And that was the absolute change or the absolute difference. In this case, it would be absolute change because I'm talking about one thing moving from the principal to the final amount. The next one you've already seen just a little bit too. We did it in the last section, which is the second way of finding the APY. APY is the annual percentage yield, which in this one, same thing, the annual return. The definition of total return is the relative, which we already talked about, the relative change in the investment value over Y years. Now I did talk about absolute change. That's the top part of this, new minus old. And then if you divide it by the old, you get the relative change. Sorry if that was confusing. Relative, remember what relative means? It should automatically pop into your head by now. Relative means percent. So I want a percent that changes in the investment over a certain number of years. Or the new minus the old over the old. The annual return is the average annual rate your money grows over Y years. In essence, if something happens in my investment and it's not a perfect change every single year, so if it's 2% and then it jumps up to 5% and it's back down to maybe 3%, what averages out as it's increasing, maybe all of these will average out to be about 4% every single year is how much it's growing in the average annual rate. So let's go to our first example, mutual fund. Edward invests $3,000 in a mutual fund for 4 years, and it grew to $8,400. Find his total and annual return. The total return, remember it's that relative change. It's the exact same formula. New minus old over old. The new number, 8,400, minus the old number, 3,000, divided by the old number, 3,000. And we get 1.8. Change that to a percent is 180%. The annual return is going to be A over P In this case, A was the amount final, 8,400, over principal is 3,000. Raise it to the 1 over y, y standing for the number of years. We have 4 years, minus 1. I can just highlight this, copy and paste, go into Excel, make it work like a calculator by putting an equal sign, paste, Control V. Oh, something's not right. Oh, it's not seeing that as a divide sign, so let's put it in again. There we go. I know this was formatted to look like currency. In our case, we're going to go ahead and say a number, 0.29. So 0.294, you could have changed the decimal percent or decimal rounding as well, and change that to a percentage, which is 29.4%. So in the 4 years, this investment more than doubled. Remember, 100% is doubling. So to double this, 100% increase would have been a $6,000 final amount. In this case, I have 8,400, which means it is more than doubling and actually almost tripled. But every year, it grew almost 30% over the 4 years. Let's move on to Roman numeral 4, investment lost. Let's say you bought some shares for $2,000. 3 years later, unfortunately, had to sell them for 1,100. Find the total and annual return on this investment. Again, our total return is just like our new minus old over the old. So our new number is the 1,100, and the old number we bought it for 2,000 over the old, which is 2,000, and that gives me negative 0.45, or changing that to a percent is negative 45%. And let's go ahead and highlight that in some fashion as the answer. That's the total return. We almost lost 50%, or half of the original investment. We were at 2,000, half would be 1,000, so a little less than half because it's 1,100. The annual return is A over P, so our final amount was 1,100. P is 2,000, raised to the 1 over Y. Y was the investment years, 3 years, minus 1. Plugging that into your calculator or Excel will give you negative 0.18. Changing that to a percent is negative 18%. So about 18% loss per year. All right, let's move on to the next one. Types of investment. There are different considerations to take into account when we're looking at an investment. The liquidity, the risk, and the return. Liquidity is how easy is it to access the money. The easier it is, the more liquid it is. The risk is the possibility of loss of your money, and the return is the total or annual money expected back. Low risk usually ends up being a low return. High risk can be a high return, but sometimes that risk doesn't weigh out and you can lose it all. So it's either a high return or a high loss. Let's go on to the next part, historical returns. This is a little different from your book now. It's from the old book, but I thought it was important to put in. The first part is the difficult part of investing is the balancing of the risk versus the return. Which one is going to work better for you in your situation? On the risk scale, we start at the top, being small company stocks are the highest in risk. Large company stocks are next, then long-term corporate bonds, and the least on the risk scale is investing just cash, U.S. Treasury bills. And the average annual return for small company stock is about 12.6%. That's if you find a good small company. So if you got in on Microsoft Windows or something like that when it was first coming out, you could have lots of money because the potential for growth is huge. Large company stocks are more established and less likely to crash, so the return or the risk is less, which means the return is a little less as well. Corporate bonds, a lot less risk, which means it has a little less return. Cash, again, less risk, less return. The best on a small company stock, if you find the right kind of company to invest in, which is why you have to do a lot of research, the best was ever 142.9%. A large company, 54%, long-term corporate bonds, 42.6, and U.S. cash, U.S. Treasury bills, 14.7%. However, small company stock also has the worst loss percent as well, and it gets progressively smaller because it gets more and more reliable instead of risky. Let's move on to our next example. You have a great grandma that invested $1,000 in 1926 in a small company stock that ended up being rather productive. What is that worth 80 years later? So we're going to use our average annual return. Compare it to what it would be worth if you invested in a different option. Okay, so we're still going to use our compound formula, compound interest. So A equals P, in this case it's $1,000, 1 plus 0.126, because that's the average annual, over 1 to the 1 times 80, because this is just one, we aren't compounding it anywhere, it's just a one-time deal. All right, plugging that into your calculator or Excel should give you $13,276,100. So if your grandma had invested that, your great-grandma, she'd be rather well-to-do, and hopefully you'd be in her will. A large company stock has its average annual return of 10.4%. Again, we're going to use our compound interest formula. 1,000 times 1 plus the APR, in this case 0.104, over, we aren't compounding monthly or anything like that, it's just the annual return. Annual meaning 1 year, so 1 times 80. Plugging that into your calculator or into Microsoft Excel, $2,738,600. I'm going to go ahead and highlight that in some fashion as the answer. So about $11 million less, but that's only if you get into a small company that ends up being profitable versus a large company, which is a lot less risky. Then the long-term corporate bond, again, even less risk, and this is 5.9%. So the same equation, 0.059, which gives you $98,100 versus just the U.S. Treasury, which, there we go for inflation, 3.7%, which isn't very much, of $18,300. So if you can find a really good company, it could be well worth your investment. Roman numeral 5, stocks. There's a couple of things we need to know before we move on into the stocks. That there are capital gains, or capital loss, and dividends. A capital gain is if you sell your stock for more money than you bought. If you sell it for less money than you bought, then it's a loss. The dividend is when a corporate distributes profits to stockholders, and each share gets the same amount of money. So if somebody owns a lot of shares, then they get a lot of money because they have it multiple times per share. Some companies, instead of taking that money and giving it back as a dividend, they reinvest it in the product, and they claim for specific examples that it is more beneficial to the company, and thus making your share more profitable, and it grows the company and your investment. So you have to kind of weigh and balance what you find is best when you make your own investments. The next one is moving on to understanding a little bit about the New York Stock Exchange. Over here we have a comprehensive quote about Microsoft and a couple of questions just so that we get familiar with it. All right, I'm going to make this line up a little bit better too. Oh, I have a couple up here I need to get rid of. All right, that fits better. Okay, let's go ahead with the Microsoft Corporation. What is the ticker symbol for Microsoft? Because they don't use the whole name when they show us what the company is. In this case, it is MSFT for Microsoft. What is the price per share at the end of the day yesterday? You'll notice that these are a little different than what the example is in your book because I took this as of today. So what was the price per share at the end of the day yesterday? So we come over here to the last, and it was $32.34, and it has changed today as of 69 cents. So when I add that, I end up with $33.03. Based on the current price, what is the total value of shares that have been traded so far? So the current price we just found is $33.03, and we have the volume of trades, 35,842,654. So I just need to multiply those together, and that will tell me the total value of what's been traded. Timesing those gives me 1,883,882,861.62 is the total value of the shares that have been traded. All right, the next question is, what fraction of Microsoft shares have been traded so far today? So we take the number of today's, the volume, 35,842,654 divided by, down here, the outstanding shares. And notice this is in millions. So I need to change this from 8,329 by moving the decimal over. Millions is 6 place values. So move that over. And here we have it 6 decimal places, 1, 2, and then I need 4 zeros to make it up 6. There we go. Multiplying or dividing that gives me 0.0043 or 0.43%. All right, suppose you own 100 shares of Microsoft. Based on the current price and dividend yield, what total dividend payment should you expect? All right, so the current price we already found is $33.03. And for the second part, the yield is over here, 2.85. So if I have 100 shares that are worth $33.03 per share, my shares are worth $3,303. With a yield of 2.85%, changing it to a decimal of 0.0285, multiplying that together gives me the yield in my dividend of $94.14. Okay, so the next question, how much profit did Microsoft earn per share in the past year? So I have earnings per share will be the share price over the price to earnings ratio. The share price we already found. The price per share is $33.03. And we can go find in our chart over here, the price to earning ratio is 11.85, and we're going to just go ahead and round it to there. Dividing that gives me $2.79 earnings for every single share. So if you had 2, you would times that by 2 and get just over $6. The next question, how much total profit did Microsoft earn in the past year? Well, if Microsoft earned $2.79 for every share, we should multiply that by the number of shares to figure out their profit for the entire year. So, how many shares? Here we go. We already used it once. Shares, the outstanding shares in millions, so I need to move this one, the decimal over 6 times because it's in millions, and millions is 6 place values over. which gives me 8,329,960,000 shares approximately times $2.79 per share will give me an approximate, whoa, we have ones to a hundred, thousands, millions, billions, $23 billion in profit just last year alone. Now, I know some of you were thinking up here, $2.79 per share doesn't sound like a lot, right? Well, remember, Microsoft is already an established large company. It's not a small stock. So yes, the opportunity to have a really big earning in 1 year per share isn't as likely, however, very stable, which takes us back to the risk versus return. And this is a large company stock. All right, let's move on to the next one. Bonds and its characteristics. There are 3 characteristics before we move on to understand bonds. The face value is the price to buy the bond. The coupon rate is the simple interest rate because bonds are usually with just simple interest, which is the interest paid on only the beginning balance, if you'll remember that. And the maturity date. This is when you can go and get your money because it is done being in the investment. There's a place called a secondary bond market where people can buy a bunch of bonds and then sell them after it's been issued, but before it hits its maturity date. And to find the current yield of a bond, it takes the annual interest payment and divide it by the current bond price. If the bond price goes or is lower, the yield is higher. If the bond price is higher, then the yield will be lower. And a bond price is quoted in points. So if it is 50 points, then it's 50% of its face value. So let's do our first example. The U.S. Treasury bond, let's say is $100 or $1,000 face value, but it's quoted at 105.97 points with a current yield of 3.7%. How much annual interest would you get in this U.S. Treasury bond? So remember, it's quoted in points and the points are a percent. So this is really a percent. And to change it to a decimal, I need to move the decimal over 2 decimal points, which is 1.0597. Times it by the face value, and it's $1,059.70. Now this is the current bond price, and now I have the yield, and I want to find the annual interest. Well, it uses this formula, but it's a little backwards because I want the annual interest payment. So I need to multiply both sides by the current bond price, so it'll cancel out. And then I have current bond price times current yield, which will give me the annual interest right here. So I have 0.3037 for the current yield, times it by the current bond price, which we just found, $1,059.70, gives you an annual interest of $39.20. And that's in simple interest. All right, let's move on to the next one. Mutual funds. This is when I have lots of people, lots of stock buyers and bond buyers who all pitch in money, and then one person manages all of the accounts. It is a lot less risky, but again, remember, less risk also usually ends up with a lesser return. This is a different example of what you find in your book. It's from the old one. The new one has a couple more questions, so I do advise you to go to page 242 and just do a couple more just so that you're familiar with it when you go through your homework, but I'm going to go through one example right now. Also, keep in mind that some of these mutual funds will have some fees for paying the people who are doing the account managing. All right, let's suppose that I invest $500 in the Calvert Income Fund for 3 years ago. What is it worth now? And this is a mutual fund So I'm going to take my compound interest formula and I'm looking for the amount final. So the initial amount, or P, is 500, and then inside here I have 1 plus. Now, here I have a different example than you do in your book. However, if you'll go to your book of 242, ours was 3 years ago, and your example, under example 10b, it's the same thing of 3 years, and you'll use your mutual fund down at the bottom, 3 years, and find the annual return. In my example, the annual return for 3 years, meaning that's how much it went up on average per year. And because my example is 3 years, we go to the 3-year one, which mine was 10.3%. Changing that to a decimal is 0.103. The example in your book, example 10b, your percent for the 3-year, the average annual return is 9.19. And so you would change that to the decimal and work with that one. Again, this was annual return. So annually is 1 time a year, 3 years, and again, n is 1 time a year. And I guess technically those should be reversed. However, 3 times 1 is the same as 1 times 3. Multiply, or plugging that into your calculator or into Microsoft Excel will get you $670.96. And that is how much your original 500 investment is now worth after 3 years. I hope you join me for the next section. If you have any questions about this one, go ahead and write me an email, and I'll try and get back to you very quickly.